Hello, fellow traders. Today we'll focus on the most critical yet overlooked aspects of trading, the psychology behind timing your trades. Whether you're buying or selling, emotions like fear, greed, and regret often cloud your judgment and lead to poor decisions. In this video, we'll highlight the importance of making decisions without regret. Regret in trading often stems in emotional reactions, like selling too early, or out of fear of holding on too long, or out of greed. These impulses can detail even the most well thought out cut strategies. Our focus today is going to be mastering FOMO, fear of missing out, and market volatility using logical, data-driven strategies. We'll use the SPY, the Spider ETF 500, as a case study because it's one of the most traded instruments in the world and provides excellent examples of how emotions and logic collide with real-time markets. Trading is often a battle between two sides of our brain, the emotional side that reacts impulsively and the logical side that relies on the data and analysis. The goal here is to strengthen your logical decision-making process while managing emotional impulses effectively. By the end of this, you'll have actionable strategies that'll leverage technical indicators like the MFI, the Money Flow Index, the DMI, Directional Movement Index, the DMA, Displaced Moving Average, and volume to time your trades better. These tools will help you navigate volatile markets with confidence and discipline. Today we'll get into the psychology of timing, how to buy or sell without regret by a pajama trader. Give this a like and subscribe. Let's get into it. Introduction to market psychology. Emotional trading costs investors billions annually. 90% of traders admit to making impulsive decisions driven by FOMO or panic. Emotional traders underperform the market by 40% over 10 years, the Dalbar study. The SPY example, in March in 2020, 34% crash saw panic sellers miss about 90% of the rebound by December. Markets are driven by human psychology, not just fundamentals. In March 2020, traders who sold the SPY at the lows locked in losses, while those who held near the full recovery saw gains. Especially like FOMO, it tricks us into acting against our best interest. So let's dissect these traps. Key psychological traps. FOMO selling. Example, SPY 5% intraday drop on 10/13/24 led to $12 billion in panic sales. Regret theory. Losers holding like ARK or ARK, negative 80% peak to trough to avoid admitting failure. 3. Herd mentality. Crowded trades. Example, SPY options volume spiking 300% during volatility. FOMO is like jumping off a boat in a storm. Short-term relief, long-term drowning. Regret theory, staying on set sinking ship. Herd mentality amplifies both. Remember, the crowd is often wrong at extremes. Impact on trading decisions. Loss aversion. Losing $100 feels as painful as gaining $200 feels rewarding. Kahneman and Tversky. Confirmation bias. Ignoring SPY's strong earnings to focus on one bearish tweet. Cycle of regret. Panic selling. Missing rebounds. Example, the SPY plus 15% in Q4 2023. Loss aversion paralyzes. Confirmation bias blinds. In 2022, traders who panic sold missed 60% of the SPY's 2023 rally. Let's break this cycle into tools that you could actually use today. Real-time case study. SPY's power hour, 3 to 4 p.m. At 3:12 p.m., the SPY's MFI hit oversold territory at a negative 20, signaling a potential reversal. By 3:15 p.m., the DMI confirmed this with the bullish crossover where the DI plus crossed above the DI minus, while the ADX showed a strong trend at 25. The volume surged by plus 45%, confirming institutional buying interest during the reversal phase, and a critical signal to look for as a trader. Scenario: 2/19/25, Trump's 25% tariff announcement triggers a 1.2% pre-market SPY drop to 598.50. Volume confirmation. The volume surged by 45% compared to the previous hour at 3:15 p.m., signaling institutional buying during the reversal phase. MFI signal. SPY's MFI hit 18, oversold at 3 p.m., signaling a potential rebound. 72% historical accuracy in range-bound markets. DMI confirmation. The DI plus crossed above the DI minus at 3:15, a bullish trend reversal, with the ADX rising to 28, a strong trend strength. The DMA support alignment. The SPY bounced off the forward displaced 20 period SMA at 6:01:20 at 3:30 p.m., confirming support and signaling entry for disciplined traders. A strategic win. Traders using the 590, the 592 put spreads combined with volume and indicator signals gained 15%, while the MFI DMI buyers profited from the 2.2% rebound by close at 611.79. At 3:15, the SPY's MFI hit oversold territory at 20, signaling the reversal. This is something to keep in mind for disciplined traders. Strategies to neutralize bias using indicators and volume analysis. Predefined rules using indicators and volume analysis. Use MFI for sentiment-based entries and exits. Exit if MFI is greater than 80 during rallies or greater than 20 in sell-offs without confirmation from other indicators. Use the DMA as a trend filter. Only trade long if SPY is above the forward displaced SMA, example DMA at 50 or DMA at 20. Confirm trends with volume. Rising volume during prices increases equal healthy uptrend. Falling volume during price drops equal potential exhaustion. Contrarian plays with DMI, MFI, and volume combo. Buy when the MFI is greater than 20 and the DMI shows plus over minus and the crossover with the ADX at 25 for trend confirmation. Confirm reversals with volume spikes greater than 30% above average. Example, October 2023 rally was plus 12% triggered by this setup. Time restricted trading using DMI, ADX, DMA support levels, and volume trends. Focus on the power hour when the DMI confirms trends and price respects DMA support levels. Use volume surges greater than 40% as a confirmation for breakouts or reversals. Rules: remove promotion bias from trading decisions. The MFI identifies overbought, oversold levels, but needs confirmation from the DMI and DMA. Volume spikes confirm institutional activity, critical for validating trends or breakouts. Combine these tools with high probability setups while avoiding emotional mistakes. Real-time strategy in action, 2/19/25. At 3 p.m., the MFI signaled an oversold condition during a tariff-induced sell-off. At 3:15, the DMI confirmed the bullish reversal. The DI was greater than the DI minus, supported by a rising ADX at 25. At 3:30, the SPY bounced off this forward displaced SMA At 6:01, aligning all the indicators for a high probability entry. The volume surged by 45%, confirming institutional interest during the reversal phase. Result, a $5 share gain within power hour as the SPY rebounded to 611 by close. That power hour was a textbook example of indicator alignment. The MFI flagged oversold conditions, the DMI confirmed the trend reversal, the DMA provided the dynamic support for entries, while the volume spikes validated institutional buying activity. This allowed disciplined traders to profit from the rebound while avoiding panic selling mistakes. Conclusion and actionable takeaways. Emotional trading costs money. Discipline pays dividends. SPY's annualized return is 10%. Emotional traders average 4%. Use indicators like the MFI, DMI, and DMA along with volume together for better timing decisions. The example from today's case study proves their effectiveness in volatile markets. Journal entry every trade. Track your biases. Refine your strategy over time. Mastering it isn't about predicting headlines. It's about following rules and indicators that cut through the noise. Use MFI for sentiment extremes. Let DMI confirm the trends, and trust the DMA as a dynamic support resistance. Validate moves with volume spikes for divergences. The market rewards discipline, and every panic-driven sale is an opportunity for those who stay calm. If you find value in this video, give it a like. Share this video with other like-minded traders or traders looking to change their trading game. And consider subscribing for more Market Edge videos and alerts. Thanks again for watching.